Trump's new One Big Beautiful Act is officially now law, and it changes how a lot of households and businesses should think about taxes moving forward. Here are 10 changes you need to know and how they affect your taxes. But before we dive in, I need to say this clearly. The internet is oversimplifying this. For example, when you hear no tax on tips or no tax on overtime, most people just assume that those dollars magically become untaxed, but that's not how this works. See, most of the big changes in a tax deduction is basically the government saying, we're going to ignore this portion of income when calculating your federal income tax. But that is different from tax-free. And all of these changes come with income limits, documentation, and expiration dates. So it's super important that you pay close attention. So in this video, I'm going to break down what changed, what the tax law used to be, who qualifies, and exactly what you need to know in plain English. And if we haven't met, my name is Kingsley Fetty. I'm a CPA, certified public accountant, and I specialize in proactive tax planning for high-income business owners and families. See, over my career, I've advised clients across more than 40 states, representing over $300 million in combined revenue. So I've seen exactly how wealthy families and business owners structure things to save thousands of dollars in taxes each year. But before we hop into it, quick disclaimer. Yes, I am a CPA, but I am not your CPA unless you hire me. So this video is for educational purposes only and not tax advice. Tax planning is highly personal and your specific facts and circumstances matter. Change number 6, the child tax credit. I know everybody loves this one. See, before the Tax Cuts and Jobs Act back in 2017, the child tax credit was even smaller. See, the TCJA increased it and there were future expiration concerns. Now what changed? The 2025 maximum child tax credit is $2,200 per eligible child, up from $2,000 in 2024. And there are still some income phase outs. So the credit begins to phase out once your income goes over $200,000 if you're single and $400,000 if you're married filing jointly. So for a family of 5, that's a free additional $1,000 tax refund increase. Sweet. Tax change number 7, seniors. There's an additional new senior tax deduction. Before this law, the senior tax break was basically this. Once you turn 65, the IRS lets you take an extra standard deduction on top of the normal standard deduction, and that has been in the tax code for a long time. What changed in this bill adds a new additional senior deduction on top of that old extra standard deduction. So it's $6,000 per eligible person, and it's up to $12,000 for a married couple if both spouses qualify. But it's not for everyone. It does start phasing out once your modified AGI goes over $75,000 if you're single and $150,000 if you're married filing jointly. And it is temporary. It applies for tax years 2025 through 2028. So in plain English, it used to be 1 senior tax break. Now it's 2 senior tax breaks, but the new one is income limited and temporary, so it does help middle income retirees the most. Tax change number 8. Now let's talk about the one that a lot of people have questions around. The new Trump accounts. Before this law update, parents typically use things like the 529 plans, custodial accounts, custodial Roth IRAs, or just taxable brokerage accounts to build future wealth for kids. Now what changed? Now there's a new type of child savings account framework with its own rules, including a one-time $1,000 government contribution for each eligible child and a structure for annual contributions. Parents, guardians, and others can contribute up to $5,000 per year, and employers may be able to contribute $2,500 per year without it counting as taxable income to the employee. But the overall annual contribution limit is still tied to that $5,000 a year cap. But here's the most important detail that a lot of videos get wrong. These accounts cannot be funded before July 4th, 2026. So if someone is telling you start funding it now, just slow down. In layman terms, the idea is this. This is an account intended to help kids build long-term wealth with restrictions on when money can come out and rules around how it's invested. And withdrawals have rules. and penalties can apply if money comes out the wrong way or too early. So the takeaway here is this might be useful for families, but it's not as simple as free money for every child, and it has a timeline. Now let's switch to business owners, because this is where the tax planning can create the biggest tax saving swings. Tax update number 9. This is where it starts to get a little juicy for my business owners. Number 9 is bonus depreciation at 100%. See, before this law update, bonus depreciation was phasing out. It used to be 100%, meaning you could buy qualifying business assets and equipment, etc., and deduct the full cost in year 1. This is where everybody wanted to buy G-Wagons and write it all off in year 1 to reduce their tax bill. But it was phasing out over time and decreasing each year. Then it started stepping down. Now what changed? This law brings back 100% bonus depreciation for qualifying property tied to specific dates and rules. Now let me explain this in everyday language. If you buy qualifying business equipment like machinery, computers, certain business vehicles, and other eligible property, bonus depreciation can allow you to deduct a large portion, sometimes all of it, in the year you place it in service. And I do want to emphasize place in service. See, buying it isn't enough. You have to place it in service, meaning it is ready and available for use in your business. So if you buy equipment in December, but don't actually set it up until January, that can change what year you get the tax deduction. And that's why timing matters. So let's talk about Section 179. Section 179 already existed and had fairly high income limits, and those limits increased over time with inflation and law changes. What happened? The limits are even higher now. Up to $2.5 million on qualified purchases can be expensed, and it starts phasing out once total qualified purchases go over $4 million. Now the difference between Section 179 and bonus depreciation in plain English is this. Section 179 is often more controlled. Bonus depreciation can sometimes be much more aggressive. And depending on your profit, your future income plans, and even your state tax rules, one approach may be better than the other. So don't just say, I'm going to write off anything. You have to plan it. Finally, tax law change number 10, QBI, qualified business income. Before this law, QBI, the 20% qualified business income deduction for pass-through entities, existed, but it was scheduled to expire after 2025 unless Congress acted. What changed? This law extended the QBI beyond that deadline, which is important for S-corps, partnerships, and even sole proprietors. In plain English, many business owners may still be able to deduct up to 20% of qualified business income, and keeping that alive is a meaningful long-term planning factor. Whew, okay, I know that was a lot, but let's go ahead and recap the 10 changes. Number 1, tips deduction. Qualified tips are now deductible for a limited time, but it does phase out at higher income levels, and you still need to report everything on your tax return. Number 2, the overtime deduction. There's a temporary deduction tied to the overtime premium portion with caps and income phase outs. Number 3, car loan interest deduction. Interest on certain U.S. assembled vehicle loans can now be deductible for a limited time with a little bit of eligibility and income phase out requirements. Number 4, the higher standard deduction has been extended. The higher standard deduction now continues, which means a lot of people still won't itemize the deductions, but the higher standard deduction means more money back into your pockets. Number 5, SALT cap increase. The SALT deduction cap increases to $40,000 for a period of years. Then it is scheduled to revert later unless they extend it. Number 6, the child tax credit increase. See, the child tax credit increased from $2,000 in 2024 to $2,200 in 2025. Number 7, the new senior tax deduction. See, seniors get an extra tax deduction on top of the existing senior tax deduction on top of the existing senior standard deduction add-on, but it phases out at higher incomes and it is temporary. Number 8, Trump accounts. A new child savings account program is created with set contribution limits and restrictions, and it can't be funded until July 4th, 2026. Number 9, 100% bonus depreciation returns. See, eligible business assets can again be fully expensed, making timing and placing them in service at the right time super critical, which means if you want to go back to buy your business a G-Wagon and use it for business purposes, you can write it all off in year one again. And number 10, the QBI made permanent. See, the 20% qualified business income deduction is extended beyond its prior date of expiration, strengthening long-term planning and pass-through entity planning. Meaning if you have $100,000 in profits, potentially you can get a $20,000 tax deduction. See, the biggest takeaway is this. This bill doesn't just cut taxes, it changes the rules. And with taxes, the people who win are the people who understand the rules early enough to plan. And if you're watching this thinking, okay, I'd love to have a tax strategy plan to pay less in taxes. That is called tax planning, my friend, and you've come to the right place. See, tax planning is exactly what me and my team specialize in for families and business owners. Click the link in the description or pinned comment to learn more about working with me and my team. And if you learned something new today, do me a favor, like, subscribe, and share this with somebody who's working on their own wealth journey. Until then, keep building and keep keeping more of what you earn. I'll see you in the next video.